Ladies and gentlemen, welcome back. Today we dive into a significant shift in the financial markets, one that's grabbing headlines and causing ripples across global trading floors. The title says it all: stocks dip as risk appetite fades. What does it mean when risk appetite fades? Why are investors retreating? And what's behind the recent dip in US equities? Let's unpack this moment together, in depth and without the jargon. To begin, the US stock market opened today in the red. Major indexes, the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite, all slipped in early trading. The retreat comes after weeks of cautious optimism, as investors had hoped for a soft landing amid cooling inflation and steady, if uneven, economic growth. But optimism is a fragile thing in the world of finance, and today, the sentiment shifted. The phrase risk appetite fades refers to a broader trend. Investors are becoming more cautious, more conservative. They're stepping away from speculative assets and favoring safer investments like bonds, cash, and blue-chip dividend stocks. So, what's driving this pullback? There are three main forces at play: 1, sticky inflation; 2, uncertainty in global politics; and 3, mixed corporate earnings. Let's break these down. Despite earlier hopes that inflation was cooling, the latest Consumer Price Index, CPI report, showed inflation isn't coming down as quickly as expected. Core inflation, which excludes volatile food and energy prices, remains stubbornly high. And that brings us to the Federal Reserve. If inflation remains elevated, the Fed may delay interest rate cuts or even consider further tightening. That means borrowing stays expensive, business growth slows, and consumer spending cools. Investors don't like uncertainty, and they really don't like prolonged high interest rates. Second, the global landscape is anything but stable. Tensions in the Middle East, particularly surrounding Iran and Israel, have flared up again. There's also renewed volatility in oil markets, spurred by OPEC plus production decisions and concerns about global supply chains. Meanwhile, in Asia, relations between the United States and China remain icy. The recent trade rhetoric has investors worried about tariffs, tech restrictions, and the long-term health of global manufacturing pipelines. In short, these uncertainties are pushing investors toward defensive positions. When people are unsure about the future, they don't bet on growth. They bet on stability. Now let's talk earnings. It's earnings season. That time every quarter when public companies open their books and tell us how they've been doing. While some giants, think Microsoft, Nvidia, and Apple, posted strong results, many mid-cap and smaller firms are showing signs of strain. Retailers in particular are reporting weaker than expected guidance, suggesting consumers are feeling squeezed. Rising costs and slowing demand are hurting margins, and Wall Street has taken note. The result? Traders are selling off riskier positions and holding cash or moving into defensive sectors like utilities, healthcare, and consumer staples. It's also worth talking about the tech sector, which has been one of the biggest drivers of the recent bull run. This year, AI and semiconductor companies like Nvidia, AMD, and ARM have been leading the charge, buoyed by intense interest in artificial intelligence and cloud computing. But today, even tech isn't immune. Why? Because tech stocks are growth stocks, and they tend to suffer more in environments with high interest rates. Investors are worried that valuations have gotten too high, that these companies may not be able to sustain their explosive growth in a higher rate world. So, we're seeing a bit of a correction. It's not panic, not yet, but it is caution. When risk appetite fades, the money doesn't disappear, it just moves. And today, it's moving into safe havens. Gold is up as usual. The metal has always been a hedge against uncertainty. Treasury yields are falling slightly, indicating strong demand for government debt. And cash, yes, plain old cash, is king once again. Investors are waiting for better entry points and are parking their funds in money market accounts, which are now yielding 4 to 5% thanks to higher rates. The key word here is defensiveness. Now, a dip in stocks doesn't always mean a downturn is coming. Let's be clear, markets breathe. They expand, they contract, that's normal. But in this case, it's not just a breath, it's a shift in tone. Short term, we might see more choppiness, more cautious trading, more mixed signals. Long term? That depends on a few key questions. Will the Fed pivot and ease monetary policy later this year? Will inflation finally cool to the 2% target? Will geopolitical tensions de-escalate or intensify? And will corporate earnings show resilience or deterioration? These are the questions driving sentiment today, and they'll continue to shape markets in the weeks to come. If you're watching this and wondering what to do with your portfolio, the answer isn't panic, it's perspective. Here are 3 key takeaways. Stay diversified. Don't bet everything on one sector or theme. Watch the data. Inflation reports, jobs numbers, Fed minutes, they all matter. Think long-term. Volatility is the price of admission for long-term growth. Remember, wealth is built over decades, not days. So yes, stocks dipped today. Risk appetite is fading. But that doesn't mean opportunity is gone, it just means the landscape is shifting. And when landscapes shift, those who stay informed, those who adapt, are the ones who thrive. Thanks for watching. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell for more market insights. Until next time, stay curious, stay smart, and stay invested.